Welcome back to the Deep Dive. Today, we're digging into AutoZone's Q1 fiscal year 2026 earnings.
Specifically, that conference call from December 9th.
Exactly. And the context here is, well, it's everything. This wasn't some after-hours call.
No, this was intraday.
The pre-market release had already hit the wires, and the market was reacting, well, violently to the headline numbers way before management even picked up the microphone.
That timing really set the stage. It created this immediate tension where the stock was already plunging by the time the CEO started his prepared remarks.
Yeah, the market had made its judgment. So our job here is to figure out that disconnect.
Right, the gap between the immediate headline disappointment and the narrative that management was trying to build on the call.
Absolutely. So our mission is to cut through all the noise. And believe me, there is some serious accounting noise in this report.
A lot of it.
And we need to figure out if that underlying story, the one about strong demand of the auto aftermarket, is still intact.
Or if that big market reaction is telling us something has actually broken.
Okay, let's get right to the numbers that caused all the pain in the first place.
Let's do it.
So the ugly headlines first. These hit, and the selling started immediately. Diluted earnings per share, the big one, came in at $31.04.
And that was a serious miss. Consensus was looking for something like $1.20 to $1.70 higher.
So we're talking a negative surprise of around 4 to 5%. That stings for a company that's known for being so consistent.
It does. And that big EPS miss just completely overshadowed what was, a pretty decent top line.
Right. Net sales landed at $4.63 billion. That's up 8.2% year over year.
Which is great growth. But even that number missed the street by a little bit, about 0.3%.
When your bottom line misses that hard, even a small revenue miss just feels like pouring salt in the wound.
Oh, for sure. And the stock reaction was just brutal. AutoZone sold off over 7% on the day.
It wasn't just a bad day for them. It was the worst performer in the entire S&P 500.
Yeah. And their biggest one-day drop since 2022. It just tells you investors were laser focused on that bottom line.
Which brings us to the elephant in the spreadsheet.
The GAAP versus non-GAAP story.
This is what drove the sell-off. And it all comes down to one very specific non-cash charge.
The LIFO ghost, as you called it?
It really is. I know a lot of you know what LIFO is, but for those who don't, can you just break down why this one accounting rule caused such a huge shockwave?
Sure. So LIFO stands for last in, first out. Just think of it simply. You assume the last piece of inventory you bought.
Which in an inflationary time is the most expensive piece.
Exactly. You assume that's the first one you sell. So your cost of goods sold on paper goes way up. It's not cash leaving the building, it's an accounting adjustment.
So the numbers we see, the reported numbers, are distorted by this.
Completely. The reported EPS was down 4.6% year over year. The gross margin dropped 203 basis points.
Okay.
That was almost entirely because of this $98 million LIFO charge. It cut their gross margin by 212 basis points all by itself.
So it was more than the entire drop.
It was. It was a surgical strike right to reported profitability.
So if we, mentally strip that out, what did management say the real earnings growth looked like?
They were very clear on this. They said, excluding that charge, diluted EPS would have been up an estimated 8.9% year over year.
So their message was, hey, we're managing the business fine, but this accounting thing is killing us.
Pretty much. They're saying this LIFO mechanism, which is tied to tariffs and inflation, is just obscuring the true earnings power of the company.
But this is where I get a little skeptical. If it's just noise, why is the CFO telling everyone it's not going away?
That's the million-dollar question, isn't it?
She guided for LIFO charges to continue, right? Something like $60 million a quarter for the next 3 quarters.
Exactly. And that's why the market's reaction in the short term was probably justified. If you know that reported margins are going to be under pressure for the next 9 months.
It's no longer just noise. It's a structural headwind to the reported number.
It absolutely is. The market has to price that in. It creates a real conviction test for investors. Do you believe the underlying story or the reported number?
Okay, so that's the accounting mess. Let's talk about the engine room, the actual sales growth, because that was pretty impressive.
It really was. Total constant currency comp sales grew 4.7%.
Which is the 6th straight quarter of comp acceleration.
You don't do that by accident. That signals real underlying strength. But it wasn't even across the board.
No, not at all. The domestic commercial business, the do-it-for-me segment, was just a monster.
The absolute superstar. Sales jumped 14.5% year over year. That's just a massive number and continues this great streak of double-digit growth.
And it seems like their strategy is really paying off there.
It is. The commercial flywheel is spinning. Average weekly sales per program were up a really healthy 10%, and it's all about those mega hubs.
They opened more this quarter?
Yep, they finished with 137 open on their way to a target of 300. These hubs just carry so many more parts, and they can get them to the professional mechanic faster than anyone else.
Now, the other side of that coin was DIY, the do-it-yourself segment.
A little softer.
Yeah, same-store sales there were up just 1.5%. And if you dig in, DIY traffic was actually down 3.4%.
Management had an answer for that, though. They blamed it on the weather.
Right, fewer hurricanes, fewer cold snaps than last year.
Exactly, especially in the Southeast and some northern markets, so fewer people needing to buy batteries, wipers, that kind of thing. They see it as just some quarterly lumpiness, not a fundamental problem.
Okay, that makes sense. But all this growth, especially in commercial, it doesn't come for free.
No, it requires a ton of investment.
And that takes us right back to profitability, specifically that SG&A line. Selling, general, and administrative expenses. It deleveraged by 69 basis points.
Meaning their operating costs grew faster than their sales, and that can be a red flag.
But management said this was on purpose.
They did. They were very explicit that this is a purposeful investment. They're ramping up capital spending to about $1.6 billion for the full fiscal year.
Mostly on new stores and those mega hubs.
Right. They're putting the foot on the gas. They opened 53 net new stores globally this quarter alone.
That's a big step up.
It is. And they actually quantified it. They said about 2 points of their SG&A growth was tied directly to this acceleration. They're paying up front for future scale.
And those investments take time to pay off.
4 to 5 years to fully mature. And they warned that SG&A growth will probably continue at this pace in Q2. They're not slowing down.
So if we zoom out, we've got a company making big strategic investments that are hurting profits now, and it's all being compounded by these LIFO charges.
It's a complicated picture.
So what's the broader context for investors trying to sort this all out?
You have to start with the tailwinds. The fundamental market is still incredibly strong.
The aging car fleet.
It's the bedrock of the whole thesis. We have about 290 million vehicles on the road. Average age is almost 13 years old. People have to keep these cars running.
And it's not just that they're old, it's that the repairs get more complex, right?
That is the key insight. The older the car, the more likely it is that something complex breaks. That pushes the repair from a DIY job to a professional mechanic.
Which drives that high-margin DIFM growth we were just talking about.
Precisely. And that complexity demands a huge catalog of parts available immediately, which, again, plays right into AutoZone's mega hub strategy. It's a huge competitive advantage.
And what about the actual customers? Are they feeling the pinch?
The CEO said the lower-end consumer is pressured but stable. And crucially, they're not seeing people trade down to cheaper parts.
Because you can't, really. You need the specific part for your specific car.
For the most part, yes. You can't just put a generic catalytic converter on a 2018 Honda. It doesn't work that way.
And what about capital allocation? That's always been a huge part of their story.
Still incredibly strong. Free cash flow is up to $630 million.
And they put that cash to work.
Oh, absolutely. They bought back $431 million of their own stock. And even with all this pressure, their adjusted return on invested capital is still insane. It's almost 40%.
So that tells you they're just phenomenal operators.
Full stop. Which brings us back to that core conflict.
The market is taking the short-term view. They see the headline miss, the margin pressure. Inventory's up almost 14%.
Right. And management is playing the long game. They're telling you, look, we're giving up some reported profit now to capture market share and build a moat that will last for a decade.
It's a classic Wall Street standoff.
It really is.
Okay, now for the part of the show where we explore some of the ideas that come up when you dig this deep into a company's numbers.
Time to connect the dots.
And we have to be very, very clear here.
The big flashing sign.
This is not financial advice.
Yeah.
This is purely for entertainment and discussion. It is not a recommendation to buy or sell anything.
Please, always consult a financial professional before making any investment decisions.
All right, with that said, what's the play here?
Well, given everything we've talked about, that sell-off, which was driven by what seems to be temporary LIFO noise and these long-term investments, it looks like a pretty interesting tactical opportunity.
In a high-quality company.
One of the best. AutoZone's operating margins are consistently in the high teens. Some of their peers are struggling to even stay above 1%.
So the market punished AZO for accounting, while maybe ignoring the huge operational gap between them and everyone else.
I think so. Which leads to a classic pair trade. You're betting on superior execution.
Oh,
The idea would be to go long AutoZone, AZO. You're buying into that long-term compounding, the high ROIC, and you'll benefit when these LIFO charges eventually fade.
and you pair that with?
A short position on one of those weaker, operationally challenged peers, one of the ones with those sub 1% operating margins.
Ah, so you're capturing the whole industry tailwind,
Yeah,
the aging fleet, but you're betting specifically that AutoZone will outperform its competitors.
exactly. You're isolating the alpha. You're betting that AutoZone's distribution network and commercial focus will just continue to widen that performance gap no matter what the accounting says in the short term.
That's a really interesting way to frame it. Okay, so to wrap this all up, AutoZone's Q1 was a tale of two reports.
It really was. On one hand, you had this incredibly strong operational execution, especially in commercial. It suggests the underlying business is growing earnings at nearly 9%.
But on the other hand, all of that good news was just completely buried by that big LIFO charge and the spending on their long-term growth plan.
Yep. Obscured is the perfect word.
So the key question for you to watch over the next few quarters isn't really if demand is there. We know it is. Old cars guarantee it.
The real question is when. When can the company get that spending under control, start to see the real benefits from these investments, and let that strong underlying growth finally shine through to the reported GAAP number?
And if they can navigate that.
If they can, then that 7% drop is going to look less like a warning sign and, more like a really attractive entry point into one of the best compounders in the entire retail sector. That's the inflection point to watch.
Fantastic analysis. And a great thought to leave everyone with. Thanks for joining us for this deep dive.
My pleasure.
We'll talk to you next time.